Hello, traders. Gary Wagner here. Approximately 11 a.m. in Honolulu, Hawaii. It is Friday, July the 1st, and this is the daily report for gold. Gold continuing to trade lower today, down another double-digit number, about $12 currently. 1487.18, and we are getting close to our close right now with about 25 minutes left in the trading week itself. As you can see, what we are looking at on our four charts is upper left 360, four candles per day, 720 below that. Two candles per day, our daily chart, and then our weekly chart. I want to start with our 360-minute chart this morning because we talked about a couple of different areas that might in fact give us some tentative support. We'll go back into our count in a second. But what you can see here is that on our weekly chart, yesterday I talked about the harmonics in terms of what we call Fibonacci harmonics, and that level right here was a 23% retracement and also a 38% retracement from two different data points, the low here and the low here. So that when we go to this chart, you can see where this particular 23% retracement level came from. We'll go ahead and take a deeper look at it. I'm going to go ahead and blow that up. And as you can see, as this marketplace came up, this is the first top that we hit. This is our record high in gold. The market came back down, and when it did, it retraced, as I said, approximately 23%, and then made a play for that top again, unable to take that out. This was 51. It came back down. Then it made a new high at 57, but still was unable to take out this particular record top. Once it did that, my belief is that we had what is called a fifth wave failure. A fifth wave failure in that it made two attempts, could not, and we actually then went into our correction or our corrective phase, and I believe that we did that right in this area at 1551. In terms of a straight wave count, my current belief is that we are in a corrective phase and a corrective wave. That being said, we are in our A wave. Our A wave right now has given us the first three waves. So where might this correction actually take us to? Traders, to do that, I'm going to pull up our daily chart and look at a couple of Fibonacci retracement areas. But the other thing that I did want to speak to you about is, if you recall on Monday, we spoke about a pattern which is basically three peaks in a doomed house. I'm going to go into that in a second because that also should give us some insight or shed some light into the potential target areas that we're going to look at for this correction to go to. Now, when we look at this chart, the one thing that you can see is we're running a retracement from 1308 to 1577. So it is the entire move that we have seen this year since what I call the January correction. When we do that, we have a couple of areas of interest. Now, you can see that as the market came down, our 23% retracement level, 1513, it was a critical area that between that and 1505. This is why it broke through that solidly. We looked at this the other day and we saw that it had become resistance as opposed to support, as you can see right in here. Now, as this market has come down, you can see that the next level, which is 1474, is an area that we came close to today in the marketplace itself, although it's closed at 87, so it's closed off of those lows right in here. Below that, our next target is going to be the 50% retracement at 1443, and our 61% retracement is at 1411. So those are going to be our critical numbers to watch. But what would actually make sense if we're having a full-blown or what we call a deep correction? And for that, my belief is that we should see some real insight by looking at the pattern and revisiting the pattern, which is three peaks and a doomed house. Now, just as a refresher from what we covered on Monday, in terms of the pattern itself, the three peaks in a doomed house, the way that it is read as follows. As the market moves up, it has a series of tops, a triple top, so to speak, that you can see right here. This is what would be called three peaks. Right here, here, and then here. From the three peaks, the market heads down to the basement. Basement being shown as this particular low here at 1308. The market would then, of course, begin to trade up and go to what George Lindsay called the first floor. This would be the first floor right in here. And then from the first floor, you would head to what he calls the roof. The roof would be our record top here. The belief is that, in essence, the market's going to run through a secondary top. It will not reach the first top. It will be a failed attempt, and then we'll go into a fairly hard retracement. His belief is that that retracement could take you anywhere between the basement and the first floor. And so what I'm looking at in terms of our retracement areas here, you have 1411 and this low being 1308. It seems as though a hard sell-off and correction could in fact take the market as low as 1414, which is that 61% retracement. We'll have to see what the market wants to do over these next few weeks. But as I said, it is currently my belief that we've entered a corrective phase. That corrective phase will, of course, be an ABC. And the difference, as we talked about last week, is that on a corrective phase, what happens on your A, rather than having a simple 3 count, you typically will get a 5 count. So 1, 2, 3. Let's assume that it finds support, 4, and then 5. That would be followed by your B up and then your final C down. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you after the 4th of July. Happy holidays all for those that live in the mainland. Canada Day for those who live in Canada. We'll talk to you on Tuesday for our next daily update after the holidays. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange